Right now, somewhere in Manhattan, a banker is telling you the market has never been stronger. He's lying. Not intentionally, but because he doesn't see what's already in motion. 14 separate warning systems, built from a century of financial disasters, are screaming the same message. The collapse isn't coming. It's already here. If you want to understand what's about to happen to your money, subscribe now, hit that like button, and don't skip a single second of this video. What you're about to learn could be the difference between losing everything and being one of the few who survive what comes next. December 2025. The American economy stands at the edge of something catastrophic. Something that repeats like clockwork every few decades. And most people won't see it coming until it's already too late. We are 16 years into the longest economic expansion in recorded history. The bull market that began in March 2009, when the ashes of the last crash were still smoldering, has now outlived every expansion cycle before it. History tells us these cycles last 5 to 7 years. Sometimes under perfect conditions, they stretch to 10. The 1990s expansion, fueled by the internet revolution and irrational optimism, lasted exactly 10 years. Then it collapsed. This current cycle has lasted 16 years. 60% longer than the longest expansion on record. We are living in the statistical exception, and exceptions, by definition, cannot last forever. But age alone doesn't kill an economy. It's the conditions. The accumulation of pressure. The buildup of leverage, of debt, of risk, hidden beneath the surface like cracks in a dam. Every major financial collapse in modern history, from the Great Depression to the 2008 crisis, follows the exact same pattern. 4 stages. 4 inevitable steps. Stage 1. Excessive optimism. Asset prices rise beyond any rational valuation. Everyone believes they're getting rich. The experts say this time is different. Stage 2. Warning indicators begin flashing. Mathematical signals that have preceded every crash start screaming danger. But they're ignored, dismissed as outdated fear-mongering. Stage 3. The trigger event. Something breaks. A bank fails. A company collapses. A geopolitical shock. The fragility is exposed. Stage 4. The cascade. Forced selling creates panic. Panic creates more selling. The system unwinds in a death spiral. Fortunes are erased in weeks. Right now, in December 2025, we are deep into stage 2. The warning systems are flashing red. All of them. Simultaneously. And just like 1929, just like 2000, just like 2008, the people who should be paying attention are telling you everything is fine. Let me show you how this pattern has repeated, without exception, across nearly a century of financial history. Because once you see it, you can't unsee it. 1929, the Great Depression. The 1920s in America were intoxicating. They called them the Roaring Twenties for a reason. The stock market had exploded upward, climbing nearly 400% in less than 10 years. New technologies, automobiles, radio waves traveling through the air, electricity illuminating cities, were transforming human civilization itself. Optimism wasn't just common. It was universal. Everyone was buying stocks. Farmers, factory workers, teachers, people who had never invested before in their lives. And increasingly, they weren't buying with their own money, they were buying on margin. Borrowing money to amplify their bets. Borrowing to get rich faster. By 1929, margin debt had reached 12% of the entire GDP. Imagine that. 12% of everything America produced was borrowed money gambling on stocks. On the surface, prosperity seemed endless. But underneath, invisible to most, the foundation was crumbling. Agricultural prices had been collapsing since 1926. Farmers across the Midwest were already going bankrupt. Consumer debt had reached levels never seen before. Families were borrowing to buy cars, radios, appliances, things they couldn't afford. The yield curve, that mathematical relationship between short-term and long-term interest rates, had inverted in 1928. That inversion is a signal. A warning that has preceded every recession in modern history. Commercial real estate in Florida, which had exploded during a massive speculation boom, crashed in 1926. Entire developments were abandoned. Banks that had financed those projects were underwater. Bank lending had become increasingly reckless. Loans were being made not based on sound business principles, but on pure speculation. The hope that prices would keep rising forever. And the experts? The people who were supposed to understand these things. They insisted everything was fine. Irving Fisher, the most respected economist in America, perhaps the world, stood before the nation in September 1929 and declared with absolute confidence, stock prices have reached what looks like a permanently high plateau. 1 month later, on October 24, 1929, Black Thursday arrived. The market crashed 11% in a single day. Panic erupted. By October 29th, Black Tuesday, another 12% evaporated. But that wasn't the end. That was just the beginning. Over the next 3 years, the market continued falling. Down, down, down. By July 1932, the Dow Jones had fallen 89% from its peak. 89%. $30 billion in market value simply vanished. 9,000 banks failed. Your money in the bank? Gone. Unemployment reached 25%. 1 in 4 workers had no job. Industrial production, the engine of the American economy, fell by half. The warning signs were there, clear, mathematical, undeniable. But the experts dismissed them. Investors ignored them. And millions of people lost everything because they believed this time was different. Now, jump forward 70 years. To the year 2000, the internet had arrived, and with it, a new kind of madness. The dot-com boom convinced an entire generation that the old rules of economics no longer applied. This was the new economy. The internet was transforming everything: how we communicated, how we shopped, how we did business. Companies with zero revenue, zero profits, zero viable business models were being valued at billions of dollars, based purely on potential, based on the promise of what they might become someday. The Nasdaq, home to technology stocks, had risen 400% in just 5 years. From 1,000 points in 1995 to over 5,000 by March 2000. Day traders were quitting their jobs. Accountants, teachers, engineers, quitting stable careers to trade stocks full-time from their homes. Everyone believed they were geniuses. Everyone believed this time was different. But beneath the euphoria, the same warning signs were accumulating. The yield curve inverted in 2000. That same signal that preceded 1929, corporate debt had reached record levels. Companies were borrowing billions to fund expansion, acquisitions, anything to justify their valuations. Margin debt had reached 2.7% of GDP, the highest level since 1929. Technology stocks were trading at 100 times earnings, or more. Many companies had no earnings at all. They were burning through cash, losing money every quarter, yet their stock prices kept climbing. The Federal Reserve, recognizing the danger, had raised interest rates from 4.75% to 6.5% by May 2000. They were trying to cool the speculation. But Wall Street analysts dismissed the concern. They insisted valuations didn't matter anymore. Traditional metrics like price-to-earnings ratios were outdated. This was the new economy, different rules. Then, on March 10, 2000, the Nasdaq peaked at 5,048 points, and then it broke. By October 2002, just 2.5 years later, the Nasdaq had fallen 78%, down to 1,114 points. $5 trillion in market value was destroyed. Retirement accounts, built over decades, were cut in half. Hundreds of dot-com companies went bankrupt overnight. Pets.com, Webvan, eToys. Companies that had been worth billions became worth nothing. The warning signs were there. Clear, mathematical, undeniable. But the experts dismissed them. And millions lost fortunes because they believed this time was different. Now to 2008, the most recent collapse. The one you might remember. The housing boom had convinced millions of Americans that real estate only goes up. From 2000 to 2006, home prices doubled nationally. In some markets, they tripled. Buying real estate became the path to wealth. Everyone was doing it. And increasingly, buyers were using subprime mortgages. No down payment required. No income verification. No assets needed. Just sign here. Banks loved this system because they didn't hold the risk. They originated the loans, collected fees, and immediately sold the mortgages to investment banks, who packaged thousands of these mortgages together into something called mortgage-backed securities. Complex financial instruments that were sliced, diced, and sold to pension funds, insurance companies, foreign governments. Everyone made fees on every transaction. The loan officer made a fee. The bank made a fee. The investment bank made a fee. The rating agencies, who were supposed to assess risk, made fees. Everyone was getting rich. And beneath the surface, the entire system was built on sand. By 2006, warning signs were flashing everywhere. Housing starts, the number of new homes being built, peaked and began falling. Mortgage defaults began rising in early 2007. The yield curve had inverted in 2006. That same signal. Consumer debt was at record highs. Credit cards, auto loans, home equity lines. Americans were drowning in debt. Major financial institutions were leveraged 30-1. Meaning for every $30 they controlled, they only had $1 of actual capital. A 3% loss would wipe out everything. But the experts insisted everything was fine. Ben Bernanke, chairman of the Federal Reserve, said in 2007 that problems in the subprime market would be contained. Treasury Secretary Hank Paulson said the financial system was sound. They were catastrophically wrong. Then, on September 15, 2008, Lehman Brothers, a 158-year-old investment bank, collapsed into bankruptcy. Credit markets froze instantly. Banks stopped lending to each other. Because no one knew who was solvent and who was about to fail. The S&P 500 fell 57% from peak to trough. $11 trillion in household wealth was destroyed. 11 trillion. Unemployment spiked to 10%. Nearly 9 million jobs were lost. Millions of families lost their homes to foreclosure. The warning signs were there, everywhere, but the experts dismissed them, and millions lost everything. 3 crashes. 3 different decades, but the exact same pattern. Excessive valuations. Easy credit. Rising debt. Warning indicators flashing red. Experts insisting this time is different. Then collapse. Total. Sudden. Devastating. Now look at today. December 2025. Look at the numbers. Look at the mathematics. And tell me this isn't the exact same pattern playing out once again. Indicator 1. The Buffett Indicator. The total U.S. stock market is valued at roughly $60 trillion. The entire GDP of the United States, everything America produces in a year, is about $26 trillion. That puts what's called the Buffett Indicator at 230%. Warren Buffett himself uses this metric. He calls it the single best measure of where valuations stand. The historical average is 100%. Market cap roughly equals GDP. That's normal. That's sustainable. The indicator peaked at 148% in the year 2000, right before the Dotcom Crash erased trillions. It peaked at 105% in 2007, right before the financial crisis. Today, we're at 230%. This is the most overvalued market in recorded history. Not slightly overvalued. Not moderately overvalued. The most overvalued market ever. Indicator 2, the Shiller-Cape ratio. The Shiller-Cape ratio, which measures stock prices relative to average earnings over 10 years, now sits near 39. The historical average is 17. The ratio peaked at 44 in December 1999, right before the dot-com collapse. It peaked at 27 in October 2007, right before 2008. We are now at 39. Stocks are trading at more than twice their historical fair value. More than twice what they should be worth, based on a century of data. Indicator 3, margin debt. Margin debt, money borrowed to buy stocks, remains near historic highs at roughly $800 billion. That's close to 3% of GDP. There are only 3 other times in history when margin debt reached these levels. 1929, 1930, 1931. Every single time it preceded a massive crash. And here's why margin debt is so dangerous. When stocks fall, brokers issue margin calls. They demand investors either deposit more cash or sell stocks to pay back the loans. Most investors don't have extra cash, so they're forced to sell. That forced selling drives prices lower, which triggers more margin calls, which forces more selling. It becomes a death spiral, a feedback loop of destruction. Indicator 4, corporate debt. Corporate debt has climbed to roughly $14 trillion. Close to 50% of GDP. The historical average is around 35%. But here's what makes this truly dangerous. Much of today's corporate debt was issued between 2020 and 2021, during the pandemic, when interest rates were at 0. Companies borrowed at 2%, 3%, thinking rates would stay low forever. That debt is now maturing. It must be refinanced. And today's interest rates are 5%, 6%, or higher. This means a company that was paying $60 million per year in interest will now pay $180 million. That's $120 million in additional expense. coming directly out of earnings. Earnings must fall. And when earnings fall, stock prices must adjust downward. But they haven't yet. The market is still priced for cheap debt that no longer exists. Indicator 5. Commercial real estate. Commercial real estate is collapsing in slow motion. Office vacancy rates remain between 20 and 30%. Downtown office buildings, once worth hundreds of millions, are nearly empty. Remote work fundamentally changed demand. And it's not coming back. Property values have fallen 40 to 60% from 2021 peaks. A building worth $200 million in 2021 might be worth only $100 million today, but here's the problem. That building has a $150 million mortgage. The building is underwater by $50 million. And roughly $1.5 trillion in commercial real estate loans mature between now and 2027. Those loans mature, borrowers must refinance or repay in full. Banks won't refinance underwater properties. That means defaults, massive defaults. And those defaults will hit regional banks the hardest. Indicator 6. Regional bank exposure. Regional banks are still dangerously exposed. Despite the bailouts in 2023, from March to May 2023, 3 major banks collapsed: Silicon Valley Bank, Signature Bank, First Republic. The failures were stopped only because the Federal Reserve intervened with emergency lending. Billions of dollars printed overnight to prevent contagion. But the underlying problems weren't fixed. They were papered over. Regional banks hold approximately $1.3 trillion in commercial real estate loans. Loans that are going bad. When those losses are recognized, bank capital will be wiped out. More banks will fail. And when banks fail, depositors panic. Bank runs begin. This is exactly what happened in 2008. Indicator 7. Consumer debt. Consumer debt has now surpassed $18 trillion. Credit card debt exceeds $1.2 trillion, with average interest rates near 22%. Auto loan debt is over $1.6 trillion. Student loan debt remains around $1.77 trillion. And delinquencies are climbing across every category. Credit card delinquencies have risen from 2.1% in 2021 to over 3.2% by late 2025. That's a 50% increase. When consumers are over-leveraged and delinquencies rise, 2 things happen. Lenders tighten credit. Consumers cut spending. Both reduce economic activity. Both push the economy toward recession. Indicator 8. Personal savings rate. The personal savings rate has collapsed. From 16% during COVID stimulus, when the government was handing out checks, to roughly 4% by late 2025. The historical average is 9%. American households have no financial cushion. No buffer, no emergency fund. When layoffs come, and they will come, these families have no reserves. They immediately fall behind on debt payments. They default. They stop spending. And this accelerates the recession dramatically. Indicator 9. Rising unemployment. Unemployment has quietly risen from 3.4% in early 2023 to around 4.5% by late 2025. That's a 1.1 percentage point increase. Most people don't pay attention to this. It seems small. But there's something called the SAM rule, named after economist Claudia Sam. The rule states that when unemployment rises 0.5 percentage points from its low, a recession has begun. Not is coming, has begun. The threshold was crossed months ago. The SAM rule has predicted every recession since 1970, with 0 false positives. 0. We're not heading into recession. We're already in the early stages. Indicator 10. Manufacturing contraction. Manufacturing has remained in contraction for most of the past 2 years. The ISM Manufacturing Index, which tracks factory activity, has been below 50 for most months since early 2023. Below 50 means contraction. The sector is shrinking. Historically, manufacturing recessions precede broader economic recessions by 6 to 12 months. This indicator is telling you the recession is already here. It's just not in the headlines yet. Indicator 11. Leading economic indicators. The Conference Board's leading economic index has declined for over 20 consecutive months through late 2025. This is the longest consecutive decline since 2007 to 2008. Index is specifically designed to predict recessions 6 to 12 months in advance. 20 consecutive months of decline is screaming that recession is imminent. Yet markets remain near all-time highs. Stock prices act like nothing is wrong. This disconnect cannot last. Indicator 12. Federal Reserve policy trap. The Federal Reserve is completely trapped. After raising interest rates from 0 to 5.5%, they've begun cutting back to around 4.5% by late 2025. They're trying to thread an impossible needle. If they cut rates too quickly, inflation accelerates. Prices rise. The cost of living spikes. If they keep rates elevated, they trigger the recession that's building beneath the surface. Corporate debt becomes unpayable. Consumers default. Banks fail. There is no path that avoids pain. The Federal Reserve is not preventing the crash. They're managing the timing, trying to delay the inevitable. But delay is not prevention. Indicator 13, Geopolitical Risk. Geopolitical risk remains at extreme levels. US-China tensions over Taiwan are escalating. The war in Ukraine continues with no resolution. Middle East conflicts threaten oil supplies and global stability. Any of these could escalate into a major shock cascading through the financial system. In an over-leveraged system, with extreme valuations, any shock can serve as the trigger. The specific trigger doesn't matter. What matters is that the system is fragile. A house of cards, waiting for wind. Indicator 14, Yield Curve Dynamics. The yield curve, that relationship between short-term and long-term interest rates, inverted for an extended period in 2023. The inversion has since corrected. But historically, the recession doesn't start during the inversion. It starts after the curve steepens again. 6 to 12 months after, we are now in that window. 14 indicators. Not predictions, not theories, current conditions, mathematical facts. And all 14 are flashing red, simultaneously. Based on historical patterns, based on the data, based on how these cycles have played out for over a century, the timeline becomes clear. Terrifyingly clear. Q1 2026, January through March. Through the first quarter of 2026, markets remain elevated. Optimism persists. The financial media continues telling you everything is fine. Buy the dip. Stocks always go up. Don't fight the Fed. But beneath the surface, stress is building. Corporate earnings begin missing expectations. More companies report declining revenues. Defaults rise in commercial real estate. More buildings are handed back to banks. Corporate debt defaults tick upward. Companies that borrowed at 2%, now facing 6%, begin to break. Q2 2026, April through June, by the second quarter, the stress becomes visible. Something breaks. A trigger event occurs. This could be a major corporate bankruptcy. A Fortune 500 company that everyone thought was stable suddenly collapses under debt. It can't refinance. Or a bank failure. A regional bank with massive commercial real estate exposure announces insolvency. Depositors panic. Or a geopolitical shock. A military conflict escalates. Oil prices spike. Supply chains break. Or a derivatives blow up. A hedge fund with massive leverage implodes, spreading contagion through the system. The specific trigger doesn't matter. What matters is that credit markets tighten immediately. Lending freezes. Stock prices fall 15 to 20%. Fast, and forced selling begins. Margin calls go out. Investors must sell. Q3 2026, July through September. The cascade accelerates. What started as a 15 to 20% decline turns into something much worse. The S&P 500 falls another 20 to 25%. We're now down 35 to 45% from peak. Hedge funds that used leverage begin blowing up. Their forced selling drives prices lower, which causes more hedge funds to blow up. Retail investors, people who bought stocks thinking they'd get rich, panic. They sell everything. Unemployment spikes towards 7%. Companies that were barely profitable begin mass layoffs. Consumer spending collapses. When people lose their jobs, they stop spending. When they stop spending, more companies suffer. More layoffs happen. The spiral accelerates. For 2026, October through December, we reach the bottom. The S&P 500 has fallen to between 2,700 and 3,500 points. A decline of 50 to 60% from peak. Trillions of dollars in wealth have been destroyed. Retirement accounts that took decades to build are cut in half. Or worse, unemployment peaks between 8 and 9%. Millions are out of work. The Federal Reserve has cut interest rates back to zero. They've restarted quantitative easing, printing trillions of dollars to buy bonds, to keep the system from complete collapse. The crash has run its course. The bottom is in. 2027. Recovery begins in 2027. Slowly recovery begins. Early investors, those who preserved capital, those who moved to cash and safety in early 2026 begin buying at the bottom. They make extraordinary returns, life-changing returns. But the majority, those who ignored the warnings, those who believed the experts saying everything was fine, those who held on hoping for recovery, and finally sold near the bottom out of fear, never recover. Their retirement plans are destroyed. Their financial futures are gone. This is not a guess. This is mathematics. Let me show you the math. The numbers that cannot be argued with. The S&P 500 is currently trading around 6,900 points. The historical average CAPE ratio is 17. The current ratio is 39. To return to the historical average, stock prices must fall 56%. From 6,900 to approximately 3,000. This isn't opinion. This is reversion to the mean. Valuations always revert to the mean. Always. Throughout all of history, after every bubble, after every period of excess, they return to average. The Buffett Indicator is at 230% of GDP. The historical average is 100%. To return to average, total market capitalization must fall 57%. From roughly $60 trillion to $26 trillion. That's $34 trillion. That must be erased. Corporate debt service costs are exploding. As cheap debt refinances at triple the interest rate, companies face hundreds of billions in additional annual interest expense. That money has to come from somewhere. It comes from earnings. Earnings must fall, and when earnings fall, stock prices must fall. Commercial real estate loans totaling $1.5 trillion mature over the next 24 months. Buildings are worth 40 to 60% less than the loan amounts. Expected losses exceed $600 billion. Banks will face insolvency or require government bailouts. This isn't speculation. This is arithmetic. The debt is real. The interest rates are real. The buildings are underwater. The losses are coming. The crash begins within 12 to 18 months. By late 2026, the bottom is reached. By early 2027, recovery begins. But the damage to the unprepared will be permanent. The difference between those who are destroyed and those who survive isn't intelligence. It isn't luck. It's preparation. It's recognizing the pattern before it completes. You have roughly 18 months. 18 months to act. Let me take you back to January 2008. The S&P 500 was trading at 1,400 points. Most people thought everything was fine. Yes, there were some problems in housing. But the experts said it was contained. Remember? Bernanke said it was contained. But a small group of investors, people who studied history, people who looked at the data, recognized the pattern. They reduced their equity exposure. They raised cash. They moved into treasuries. Some bought gold. They prepared. By March 2009, just 14 months later, the S&P 500 hit 680 points. Down 51%. Those who prepared in early 2008 preserved their capital. And when the market bottomed, when everyone else was in panic, they bought stocks at 50 cents on the dollar. And they made fortunes in the recovery. Those who believed the optimists, those who listened to the experts saying don't sell, lost half their wealth. Half, and many never recovered. If someone had told you in January 2008, with absolute certainty, that a crash was 9 months away, would you have acted? Would you have protected yourself? You're being told right now, the crash is 12 to 18 months away. The indicators are clearer than they were in 2008. The valuations are more extreme. The debt levels are higher. The fragility is worse. Act accordingly. Time is not on your side. Every day you wait is a day closer to the trigger. Every week markets climb higher on borrowed optimism is another week the fall will be steeper. The crash is coming with mathematical certainty. The same 14 indicators that predicted every crash since 1929 are flashing red. Simultaneously. All of them. The valuations are unsustainable. The debt is unpayable. The system is over-leveraged beyond any historical comparison. When it gives, and it will give, the unwind will be violent, fast, and unforgiving. You have 18 months to prepare. 18 months to reduce your risk exposure. 18 months to build cash reserves. 18 months to move out of vulnerable assets. 18 months before the largest wealth transfer since 2008 separates the prepared from the unprepared, the informed from the ignorant, the survivors from the victims. The pattern is clear. It has repeated for over a century. 1929, 1930, 1931, 1929, 1930, 1931, and now, December 2025. The same conditions. The same warning signs. The same expert dismissals. The same public optimism. And inevitably, the same outcome. Collapse. The timeline is set. The mechanisms are in motion. The crash is inevitable. The only question that matters now is whether you'll be ready. Whether you'll recognize what's happening before it's too late. Whether you'll act while there's still time. If this video showed you the 14 warning signs flashing red, if you understand the mathematical impossibility of current valuations continuing, if you see the historical pattern repeating right in front of you, then act now. Share this with everyone you know. With family, friends, colleagues, people who have their life savings in the market, not knowing what's coming. Subscribe to this channel for updates as events unfold. Hit the like button so more people see this warning. You have 18 months. The window is closing. This is not financial advice. This is research data showing a pattern that has repeated for over a century and is repeating once again, right now. Understanding the pattern is the first step to surviving what's coming. The information is in front of you. The choice is yours.